Welcome to Stu-C TV, your exclusive platform for cracking JAIIB and CAIIB exams. Today we will learn about different elements of balance sheet. The balance sheet is a snapshot of a company's financial health at a specific point in time. It's built on the fundamental accounting equation: assets equals liabilities plus equity. Understanding each element is key to mastering financial analysis. Let's start with assets. Current assets are those that can be converted into cash within 1 year. They are vital for a company's short-term operational needs. These assets are typically held for short periods and are in constant circulation within the business. Think of them as the lifeblood of daily operations. Common examples include cash, accounts receivable, and inventory, such as raw materials and finished goods. These are crucial for a business's immediate financial needs. It is crucial to clearly distinguish current asset from fixed assets or other non-current assets. The use case dictates classification. For instance, while a motor car owned by a business for the CEO is its fixed asset, the cars that an automobile company holds in its assembly line will be current asset. Beyond current assets, we have fixed assets. These are long-term assets not expected to be converted into cash within a year, such as property, plant, and equipment, which support long-term operations. Then we have other non-current assets, which includes assets that are not expected to be converted into cash, consumed or sold within 12 months of the balance sheet date, or the normal operating cycle of the firm or business. And at the same time, they are not even fixed assets. Formally, a non-current asset is defined as anything that is not classified as a current asset. Investments in and advances to subsidiary companies or sister concerns, trade investments, intercompany loans, book debts outstanding for more than 180 days, non-consumable stores and spares, and advances to suppliers of capital goods. The term other non-current assets is used to differentiate them from fixed assets, which are also non-current. Next, we delve into intangible assets. These are assets that lack physical substance, but hold significant value for a company. They represent rights, privileges, or competitive advantages. The value of intangible assets is derived from their potential to generate future economic benefits. This can include anything from brand recognition to technological innovation. Intangible assets can be categorized as limited life, like patents that expire, or unlimited life, such as trademarks, which can last indefinitely. Each has different accounting treatments. Now, let's explore fictitious assets. These are not assets in the true sense, as they don't have a realizable value or generate future economic benefits. They are essentially expenses that have been deferred on the balance sheet. Examples include preliminary expenses, underwriting commissions, and accumulated losses. These are written off against future profits, rather than being sold or converted to cash. From a bank's perspective, fictitious assets are often disregarded when assessing a company's financial health, as they do not represent any real security for loans or credit. Fictitious assets are like intangible assets, which do not exist in physical form. Benefit and write-off. They represent deferred revenue expenditure, whose benefit is derived over a long period of time. Accumulated losses are also considered fictitious assets, as they are written off over a period of time. Their balance sheet treatment is as follows. These are items which cannot be transferred to P&L account of a particular period. Thus, these are shown on assets side of the balance sheet to be written off to P&L account in reasonable years. Their relationship to intangibles. All fictitious assets are intangibles, but all intangible assets are not fictitious. Moving to liabilities. Current liabilities are obligations due within 1 year. These are crucial for understanding a company's short-term financial obligations. Medium and long-term liabilities are debts and obligations due beyond 1 year, such as bank loans, bonds, and deferred tax liabilities. They reflect a company's long-term financing strategy. Here are some examples of medium-term liabilities. You've now got a solid grasp of the different asset and liability categories that form the backbone of a balance sheet. Remember the distinctions between current and non-current assets, the unique nature of intangible and fictitious assets, and the different types of liabilities. Proper classification of these elements of balance sheet is crucial for scoring in JAIIB and CAIIB exams. A Attempt the following case studies to test your understanding. You should expect similar questions in the exam. You can now pause the video and attempt this question. Once completed, move on to next question. Remember, preliminary expenses not yet written off is a fictitious asset. These do not represent realizable value. Hence, they must be deducted from net worth while assessing financial strength. Net worth is calculated as owner's funds minus intangible or fictitious assets. Thanks for watching.